Well, let's bring in Professor Jeremy Siegel. He is Professor Emeritus of Finance at the Wharton School of Business and a Chief Economist at Wisdom Tree, of course. Professor Siegel, good to have you. I mean, pick your spot here in terms of weighing in on whether you feel as if this long-heralded broadening of the market is going to stick with us for a while. Is it durable? And where she would expect it to go from here?
Yes, good morning, Mike. Listen, I think this has legs. You know, how many head fakes did we have last year? Oh, everyone called it. And, you know, we had like a week where we had value stocks, smaller stocks outperform, and then it just reverted. But I think what we've seen and it's more than just this year, you know, through December, I think there's been questions about the Mag 7, the only AI trade. And listen, it isn't that they're not great companies. It's that are they going to be the leaders in 2026? And as you mentioned, I think the headwinds are a stronger economy that really does favor value stocks, smaller stocks. I think we've got 2 more rate cuts coming. The short-term interest rate is much more important to smaller stocks than it is the larger. I don't really expect much of a decline in the 10-year bond, but short rates do help that small sector. And then, you know, we do have the tax cuts and others that are going to power consumer spending. We don't quite know GDP third quarter over 4. I don't know if I really believe St. Louis. They say fourth quarter is over 5. There's a lot of question. We have to learn about some gold flows might subtract from that figure. But we're heading into 2026 at a very, very strong rate.
It does seem as if, we finished up last year strong, and we do have some of those tailwinds on the fiscal side kicking in early this year. I guess the question I've always had about, you know, this idea that smaller stocks and value stocks can take the lead is that they seem to obey maybe a little more of a valuation ceiling than, you know, these world-beating growth names that have addressed these huge markets and have been able to grow at, you know, super GDP rates forever. So I wonder if that's going to be a complication in the story.
Well, it is, but when you sell at 15, you don't need much growth to have a really good return. If you work through the mathematics, so if you just even grow at the level of nominal GDP and don't super grow, you're going to get some really good returns from a 15 PE stock. Now, when you have a 30 or a 40 PE stock, you can't have that. So the leverage is so much higher on a little bit of growth to get those multiples higher and to get that good return, that this could be there. And by the way, I think another thing that's powering it is this the year of the AI user and not just AI supply. We all know that only 15-20% of firms have really substantially incorporated AI into trying to lower costs. There is a lot out there that can, talking about this is the year where costs could be cut, margins could be improved for those, and with the leverage of a low PE, they could be the outperformer.
And we are starting to hear that from companies on their earnings calls when they're talking about the ways that they're using AI in the back office functions and reducing headcount. Alternately, what's your prediction about what that means for the labor market?
Well, there is a big question there on that. I mean, if you look through the history of technology, there's always other jobs that people rotate on them. Is this going to be faster than what we've seen before? That's a question, but I think, thank goodness, we're not entering into this period in a recession. Job openings are still strong. The labor, unemployment rate under 4.5% is still one where people can find those jobs. But you think of what the margins will be. I mean, I think I've even witnessed it at my company how my commentary gets written in ways that are so much faster and more effective than what we had before we had AI, and how much savings of time and energy that. And you go across firms, you could really see, profit margins rise 2-3 percentage points just by moderate incorporation of AI technique.